The third thing we can look at is operational expenses. If you see, the structure of the P&L in most companies is the same. First we have sales, then we have COGS, then operational expenses that are normally fixed costs, and then afterwards some financial expenses and the profit. Now in this specific company, what are the operational expenses? Well, operational expenses in a company that is distribution is basically the costs of light, of salaries of the people and overheads, right? So those operational expenses, again, as absolute number tells us not much, but when we look at them as a percentage of sales, we can see that they went from 29 and then to 24 to 20 and 19. I asked you, does it make sense to have at the beginning high operational expenses over sales and then lowering down unto 19 or not? If you think for a second, you would say, it does make sense, right? Because I started with the same employees, with one truck, and at the beginning I sold less than $1 million. And then with the same employees and the same truck and the same warehouse, I am able to sell now in 2007, $3 million. So with the same staff, I'm able to sell more. It means that as a percentage of sales, the OPEX are lower, right? But as you see, the first year we were able to lower the OPEX from 29 to 24, which is 5 points. But then from 24 to 20, which is 4 points. And then for 20 to 19, which is 1 point. What is your guess about next year? Do you think we're going to be able to lower it to 18 or 17? My guess is no, because you've already reached something that we call the economies of scale, which is with this fixed cost, with this truck, with these people working for us, we're able to maximize the efficiency in the company. So it seems like we've reached this efficiency, right? In this part, OPEX, we have the number that goes down and is stable, and it should be decreasing when sales go up. Now, the next thing, and we're getting to the end of this part, is EBITDA. Now, many companies actually ask the managers for EBITDA, because managers are responsible for what happens above the EBITDA, right? How do you manage your sales? How do you manage the costs? And how do you manage the OPEX? But below the EBITDA, you have depreciation, which sometimes does not depend on the manager. And you have financial expenses that many times does not depend on the manager of that division, right? And EBITDA, in this case, is minus 6%, goes 0, 4, and 4. Which tells you more or less how efficient you are. It takes into account both the gross margin and the OPEX together, right? Now let's talk briefly about financial expenses, financial results. So this part in the P&L tells you the interest that you are paying the bank for the debt that you have. Imagine that you ask the bank for 100 euros and you have to pay an interest. That interest that you have to pay, as Mark Badia in the previous course told you, goes into the P&L as a financial expense. Now, how do we know if this financial expense is high or low? Well, I tell you, normally the ratio that banks use is EBIT over financial expenses, which is how much earnings before interest and taxes have you produced compared to the financial expenses that you have. And they normally ask to have at least 2.5 EBIT for each financial expense. And if you see 88 over 30 is around 3. So it's above what the banks normally ask for. Now let's go into the last two parts, which is the income. Let's look at the income, net income. As we saw at the beginning when we started analyzing the P&L, we saw that the first 2 years we have negative net income and the following 2 years we have positive net income. Now, net income as such, it doesn't tell us much. We know that there's 44,000 euros of net income, but we don't know where it's coming from. So it's good to compare it with sales again. That's what we look at, return on sales. The return on sales goes from minus 7% up to 1.5. Now, you see that it is pretty low, right? It is pretty low, but it's positive. It makes sense that it's low because distribution companies normally tend to have very low return on sales because, as we said at the beginning in the business analysis, the value added is very small. But it's also interesting to look at the net income not just as a percentage of sales, but to look at the net income at the whole amount. see that 44,000 is the profit. With MARPA-DI, you understood that cash flow is, in a very general and simple formula, is profit plus depreciation. Because depreciation, you don't lose money from depreciation. Okay, so 44,000 plus depreciation, which is 31, you get 75,000. Now this gives you roughly an idea of how long it would take you to give back that credit of 500,000 that you're asking the bank. If each year you're making 44,000 plus depreciation 75,000, it might take you 7 to 8 years to pay back that loan. So it's good to look at the net income compared to the debt that you are asking for.